Imagine walking down a busy street in New York at the end of the 1920s. The city pulses with energy. New cars, illuminated shop windows, radios broadcasting news of a bright future. The world seemed to have discovered the secret of eternal prosperity. It was the era of jazz, of speed, of social ascension within reach of anyone bold enough to take a risk. At least, that was what everyone believed. But stories that begin with too much shine usually hide long shadows behind them. The year was 1929, and no one wanted to look at the shadows. Wall Street had turned into a kind of temple. Ordinary people, who once dreamed slowly of stability, now saw the chance to get rich quickly. Not just bankers and industrialists, teachers, farmers, housewives, elevator operators, everyone wanted their share of the radiant future. And behind every investment, every bet, there was a silent promise. This time is different. That phrase is the beginning of all financial tragedies. But what almost no one knew was that much of this prosperity was built upon fragile ground. A ground not made of gold, nor productivity, nor technological progress, but of credit. Cheap, easy, abundant credit. Borrowed money used to buy stocks that were also bought with borrowed money. A house of cards sustained by confidence, and only confidence. And confidence is the most volatile of human resources. Banks offered margins that allowed people to buy 10 times the real amount they had. If someone had $1, they could bet 10. If everything went up, exponential profit. If it fell, total loss. And because the market rose, always rose, everyone believed that falling was a distant, almost fantastical possibility, like believing the sun might not rise the next day. Collective psychology is a powerful force, more powerful than numbers, more powerful than data, more powerful even than governments. When an entire group believes that getting rich is inevitable, nothing seems capable of stopping the momentum. Headlines fueled the dream. Newspapers said the American economy had entered a new era. And, like all new eras, it promised to be eternal. But nothing is eternal in the economy. Nothing. There were signs, of course. There always are. But no one likes the person who interrupts the party to say the floor is collapsing. The few economists who warned were mocked as pessimists, outdated, out of touch. Optimism was more profitable, and blind profit is always more seductive than prudence. Then came autumn, October 24th, 1929. The first crack appeared. The day before, no one imagined. The day after, no one remembered how they couldn't have imagined. Prices began to fall, slowly at first, then fast, then in free fall. Panic. Phones ringing, sell orders after sell orders. There were no more buyers, only fear. Millions lost their savings. Banks closed. Entire families saw years of work evaporate in days. It was not just a financial crisis. It was a crisis of confidence, a crisis of identity. The world discovered that it can collapse silently while still smiling. And yet, this story did not stay in the past. It remained alive, silent, dormant, waiting for a new stage. Because the ghosts of 1929 did not disappear. They just learned to change clothes. To understand why 1929 never truly ended, we must look beyond charts, beyond statistics, beyond the narratives of history books. Financial crises are not only economic events. They are psychological events. They happen first in people's minds and only later in the markets. The economy is built on an invisible but absolutely central element: confidence. Confidence is what makes a piece of paper have value. Confidence is what makes you believe your money will be in the bank tomorrow. Confidence is what makes millions of people simultaneously agree that a number on a screen represents real wealth. And nothing wears out as quickly as confidence. To visualize this, think of a suspension bridge. While it appears stable, everyone crosses. But if someone says it might collapse, even without proof, people begin to hesitate. A slower step, a glance downward. Suddenly, someone runs back. And then panic spreads. That is how markets work. In 1929, the logic seemed perfect. If everyone believed prices would rise, they really would. That is the nature of bubbles. They sustain themselves as long as everyone plays the game. But every bubble holds within itself the seed of its own destruction. Because, to keep growing, it needs constant optimism, and optimism is a limited emotional resource. People get tired. Expectations grow too fast. The market rises more than reality can support. Then a very specific, very fragile moment appears that defines history. It is not when the first investor sells his stock. It is when the second does the same. That moment is everything. Because the first one can be seen as unlucky or eccentric. But the second is the mirror. He silently says, "If he is getting out, maybe I should too." That is how herds form. And that is how herds collapse. But the most intriguing part is that, even after 1929, even after the collapse, even after all the pain, the pattern did not end. It merely changed shape. Decades passed. New technologies appeared. New forms of investment emerged. But human psychology stayed the same. In the 1990s, it was the internet bubble. In 2008, it was the housing bubble. Today, it is a far more complex mix. Stocks, cryptocurrencies, real estate, sovereign debt, derivatives, all interconnected. And beneath everything, as always, the same universal belief. This time is different. But it is never different. Technology changes. Trends change. The terms change. Even the financial instruments change. But humans do not change. They still desire quick prosperity. They still fear missing out. They still believe good times will last forever. And they still despair when they realize they will not. The essence of the cycle is this. 1. Euphoria. Nothing can go wrong. 2. Excess, credit, leverage, speculation. 3. Crack, loss of confidence. 4. Panic, selling, bank runs, collapse. 5. Forgetting. History is erased. 6. Repetition. Everything begins again. And it is precisely in forgetting that the danger lies. Because while human memory is short, the financial system is long. The market does not need to convince everyone at once. It only needs to convince one generation at a time. The ghosts of 1929 never disappeared. They are quietly alive in every buy click on the stock exchange, in every video promising quick wealth, in every brokerage ad offering safe leverage, in every conversation where someone says, "I know it's expensive, but it's going up, so it must keep going up." And this is where the story becomes unsettling. We do not learn from the past. We simply forget it too quickly. Take a deep breath now and look around. Not at the past, at today. Because the story of 1929 is not just a closed chapter. It is a structure, a pattern that rearranges itself as time changes. And today, it has returned. With new clothes, new languages, and new disguises. Walk through the streets of major cities. The buildings are still tall. The shop windows are still bright. The screens are still broadcasting optimism. But, just like in the late 1920s, there is something trembling silently underneath. Today, the source of euphoria is not only in the stock market. It is in what we call digitalized wealth, numbers that rise on screens, charts that always seem to point upward, valuations that appear natural, inevitable, deserved. But, just like in 1929, Much of this is disguised credit. Only now the credit doesn't just finance houses and companies. It finances the very perception of value. Governments have printed trillions of dollars to sustain economies during recent crises. Interest rates were reduced to levels near zero. Central banks ensured that money continued to flow at any cost. This is where the echo of 1929 lies. Cheap debt creates easy wealth. Easy wealth creates exaggerated optimism. Exaggerated optimism creates bubbles. And bubbles always return to dust. The bubble of the current decade, however, is more silent. It is not concentrated in a single point, like real estate or tech stocks. It is distributed throughout the entire system. Overvalued real estate, stock markets at record highs, unpayable government debts, maxed out credit cards, zombie companies surviving only through loans, crypto assets driven more by emotion than function. The difference between today and 1929 lies in speed. In the 1920s, news traveled by newspaper. Investments were made by telephone. Fear and euphoria spread over days or weeks. Today, everything happens in seconds. A tweet, a rumor, a viral video, a falling chart, and instantly millions react. Confidence, which was already fragile, is now flammable. And this is where the ghost of 1929 becomes more visible. The same conditions that preceded the collapse back then are present now, except amplified. In 1929, optimism came from the stock market and industrial expansion. Today, it comes from exponential technologies, cryptocurrencies, financial hype, and digital platforms. In 1929, leverage was in margin loans for buying stocks. Today, it is in mortgages, government debts, derivatives, and endless financing. In 1929, panic took time to cross borders. Today, it crosses the planet in seconds. The difference is not in the system. It is in the speed. The screens changed, but we did not. And there is an even more frightening detail. In the past, when the system entered crisis, there was a natural break: gold. Today, there is no break. Money is no longer tied to anything physical, concrete, or limited. It is tied only to confidence, precisely the resource that dissolves first when fear appears. This means the next economic slowdown, when it comes, and it always comes, may not spread through just one country. It may spread across the entire world at the same time, because the global economy today is a single organism. There are no isolated islands anymore. What happens in an Asian market crosses oceans in seconds. A failing bank in the United States can collapse a company in Brazil, which can affect a supplier in Europe, which can impact a salary in a small village anywhere on the planet. It is the same pattern as 1929, but now at planetary scale. And there is something even more delicate. People believe that central banks will always be able to save everything again. But one day, the cost of the rescue becomes greater than what is being rescued. And when that day comes, the question will not be, why did the collapse happen? The question will be, how did we not realize we were already in it? Perhaps the most important question is not why crises happen, nor even how they happen, but why they keep coming back. Because, if logic were enough to prevent financial collapses, 1929 would have been the final chapter. If pain were enough to teach, 2008 would not have happened. If information were enough, no one would repeat the same mistakes their grandparents did. But the truth is simpler and more uncomfortable. We forget. We forget because the present is always more seductive than the past. We forget because comfort is more desirable than caution. We forget because, in the end, every human being wants to believe that tomorrow will be better. And that belief, however noble, can blind us. The story of 1929 is the story of ordinary people, like us, believing in something too big to be questioned. It is the story of how hope can turn into euphoria, and how euphoria can turn into blindness, and how that blindness can cost an entire civilization. But there is something even deeper. Despite all technological, social, political, and cultural differences between 1929 and today, the core of human decision-making remains the same. It doesn't matter if the investment is being made by rotary phone or by a smartphone app with colorful charts. It doesn't matter if a rumor spreads through printed newspapers or 15-second videos. It doesn't matter if the asset is land, stocks, or cryptocurrencies. The desire is the same. The illusion is the same. The psychological mechanism is the same. To believe that we can control the future. To believe we understand what is happening. To believe that this time is different. But history has a subtle and relentless way of testing our memory. And when it does not knock on the door. It enters. Today, we look at rising charts, at new markets, at new technologies, at new business models that promise to reinvent the world. The narrative is seductive. Efficiency, innovation, democratization of wealth. All of that sounds beautiful, and part of it is true. But the risk has never been in the technology, nor in the market, nor in the financial system. The risk has always, and still is, in us, because it is we who press the buy button. We who believe or doubt. We who decide what has value and what does not. The economy is just the mirror. It only reflects what already exists inside people. And if what exists is fear, haste, competition, and the desire for quick results, then the mirror returns exactly that. This is why 1929 is not a ghost of the past. It is a reflection. It repeats because it remains alive in our daily choices. Every time someone invests without understanding. Every time someone takes credit because everyone else is doing it. Every time someone confuses price with value. Every time someone believes that risk doesn't exist when they are winning. In these small everyday gestures, 1929 breathes again. That is why the real question is not whether there will be another great crisis. The question is when collective memory will fade enough for the next euphoria to seem inevitable. And perhaps we are closer to that than we like to admit. But understanding this cycle, observing its patterns, recognizing its signs, seeing its phases, is the most powerful way to see clearly again. Not to flee from the system, not to fear it, but to avoid being devoured by it. Because in the end, the market does not reward those who run the fastest. It rewards those who can see when everyone else is blind. And when the next party begins, because it always begins, the question will be, will you be part of the crowd that dances without looking at the floor? Or will you be the one who recognizes the ancient sound of history's footsteps? The story is not over. It is being written now.